Imagine earning what most people would call a good salary. You did everything right, studied, built a career, climbed your income ladder. Then you start house hunting, and suddenly the numbers don't make sense. Homes you thought were affordable are stretching your budget. Monthly payments feel heavier than expected, and you're left asking, how much house does my salary actually buy? Today, we're breaking that question down, not with hype, not with unrealistic promises, but with real math, real constraints, and the financial mechanics behind affordability. Because buying a home isn't just about what a bank says you qualify for, it's about what your income can safely support, long term. And those are often two very different numbers. What people think they can afford. Most first-time buyers start with a simple idea. I make X dollars per year, so I should be able to buy Y. But income alone doesn't determine affordability. Lenders don't look at your salary in isolation. They examine something called your debt-to-income ratio, or DTI. This measures how much of your gross monthly income is already committed to obligations: car loans, student loans, credit cards, existing housing costs. From a lender's perspective, your mortgage payment must fit inside a risk threshold. A common guideline is that total monthly debt payments shouldn't exceed roughly 36 to 43% of gross income. That sounds manageable until you translate it into real housing numbers. Because your mortgage payment isn't just principal and interest. It includes property taxes, homeowners insurance, maintenance buffer, and sometimes HOA fees. This is where expectations collide with reality. A salary might look strong on paper, but once real ownership costs are layered in, purchasing power shrinks. The true cost of a mortgage. Let's walk through a simplified scenario. Suppose someone earns $90,000 per year. That's $7,500 per month before taxes. If we use a conservative housing ratio, say 28% of gross income, that suggests a target housing payment around $2,100 per month. Now comes the key insight. That $2,100 is not the loan payment, it's the total housing budget. From that, you subtract taxes, insurance, maintenance reserves. What remains is what actually services the loan. Depending on interest rates, that payment might correspond to a home price dramatically lower than buyers expect. And interest rates matter a lot. A 1 percentage point rate increase can reduce buying power by roughly 8 to 12%. That means two buyers earning identical salaries just a year apart can face very different affordability ceilings. Your income didn't change, the market conditions did. Why bank approval does not equal safe affordability. Here's a critical distinction. A lender approves the maximum risk they're willing to accept. That does not equal what's financially comfortable for you. Banks assume stable employment, no income disruption, consistent expenses. Real life rarely behaves that cleanly. Unexpected costs happen. Car repairs, medical bills, job transitions, family obligations. If your mortgage consumes too much income, every surprise becomes financial stress. This is why many financial planners suggest a stricter personal affordability rule than lenders do. The goal isn't just approval, it's sustainability. You want margin, breathing room, not a payment that dominates your paycheck. How lifestyle affects buying power. Two people earning the same salary can afford very different homes. Why? Because affordability is shaped by lifestyle structure. Debt levels, savings habits, childcare costs, commuting expenses, insurance burdens. A high earner with heavy obligations may have less purchasing power than a moderate earner with clean finances. This is why focusing only on income gives an incomplete picture. Affordability lives at the intersection of income, expenses, risk tolerance, and long-term goals, and ignoring any one of these creates financial fragility. The hidden costs of ownership. Renters often compare mortgage payments to rent, but homeownership carries additional layers: maintenance, repairs, appliance replacement, property upkeep. A common rule of thumb is budgeting 1 to 2% of home value annually for maintenance. On a $350,000 home, that's $3,500 to $7,000 per year. These costs don't arrive monthly, they arrive unpredictably,
and they're part of what your salary must support. Ignoring them leads to a distorted affordability picture. So when someone asks, how much house can my salary buy? The honest answer isn't a single number. It's a range, shaped by financial discipline, market conditions, risk tolerance, and lifestyle design. The difference between stretching to qualify and buying sustainably can define your financial stability for decades. And that's what we're going to unpack next: how to calculate a realistic affordability ceiling, how interest rates reshape buying power, and how to avoid becoming house poor. Because the goal isn't just to buy a home, it's to own one without sacrificing your future. Let's move from theory to mechanics. Instead of asking, what home price can I qualify for, we ask a better question: what payment can my financial life safely absorb? Step 1 is identifying your true monthly take-home pay, not your gross salary. Taxes, insurance, and retirement contributions shrink what actually hits your bank account, and your mortgage is paid with real dollars, not pre-tax math. Now subtract essential living costs, existing debt payments, savings contributions, and irregular expenses averaged monthly. What remains is your safe housing margin. Notice this number is often smaller than lenders' formulas suggest. That's intentional. We're designing affordability that survives real life, not ideal conditions. Once you have that margin, reverse engineer the mortgage. Estimate property taxes, homeowners insurance, maintenance reserves, and subtract those from your safe housing margin. What's left supports principal and interest. That determines your practical home price, grounded in sustainability, not optimism. Interest rates, the silent buying power shifter. Most buyers focus on price. Professionals focus on payment because interest rates quietly reshape affordability. Here's the mechanism. Mortgage payments are a function of loan size and borrowing cost. When rates rise, more of your payment goes to interest, less goes towards principal, and purchasing power declines. Even modest rate shifts compound over decades. A higher rate doesn't just change the monthly bill, it changes total lifetime cost. This means two buyers with identical salaries and down payments can afford very different homes depending on rate conditions. Your income didn't change, the market conditions did. Down payments and leverage reality. Down payments influence affordability in three ways: lower loan balance, reduced monthly payment, and improved lender terms. But liquidity matters too. Draining every dollar into a down payment can leave you asset-rich and cash-poor. A financially stable purchase balances equity position, emergency reserves, and moving and setup costs. Remember, owning a home introduces financial variability. Cash reserves absorb shocks. Without them, small issues become high-interest debt, undermining the very stability ownership is meant to provide. The house poor trap. House poor isn't about income level, it's about cash flow rigidity. A buyer becomes house poor when housing consumes so much income that savings stall, lifestyle compresses, and emergencies create stress. The risk isn't immediate catastrophe, it's long-term fragility. Financial growth slows because surplus cash disappears into fixed obligations. A home should support your life, not dominate it. Healthy ownership leaves room for investing, career transitions, family needs, and unexpected expenses. If buying eliminates flexibility, the structure is too tight. Regional cost reality. Housing affordability isn't universal. Taxes, insurance markets, and property prices vary dramatically by region. Two identical salaries produce very different housing outcomes depending on location. This is why comparisons between cities can feel distorted. Affordability must be evaluated within local economic conditions: cost of living, tax structure, insurance environment, employment stability. Ignoring these factors leads to unrealistic expectations. Salary alone never tells the full story. Rent versus buy, the opportunity lens. Buying a home is often framed emotionally, but financially it's a capital allocation decision. Ownership builds equity, but it also concentrates wealth into a single asset tied to a geographic market. Renting preserves liquidity and flexibility. Neither is universally superior. The correct choice depends on time horizon, career mobility, savings discipline, and market conditions. Affordability analysis should include opportunity cost, what happens to money not tied up in housing. The goal is alignment with long-term financial strategy, not social expectations. Stress testing your purchase. Before committing, simulate pressure. Ask, what happens if income drops temporarily? What if maintenance spikes? What if property taxes increase? A resilient purchase survives stress scenarios without forcing debt accumulation. This exercise reveals whether your affordability model is robust or fragile. Financial resilience is built before the purchase, not after. At this point, the question evolves. It's no longer how much house can I buy? It becomes how much house strengthens my financial future. That distinction changes everything because sustainable ownership is about margin, flexibility, and long-term alignment, not maximum qualification. Next, we'll examine real-world salary scenarios, how lifestyle choices reshape affordability.